I'm going to hand things over here to Matt McIlwain, Managing Director of Madrona Venture Group. They're a sponsor. And Matt's going to give a presentation. He's going to introduce a few panelists. So our plan for today is to close out with 3 great panels. And the first one, Matt's going to lead. So I'm going to hand it over, and I'm sure we'll have time for Q&A after each of the panels. So Matt, please come up on stage.
Well, thanks, Steve. And again, thanks, everybody. It was really fun to visit with many of you last night over dinner. I found Bob's presentation and then Kai-Fu's sort of challenging of maybe some of the thought processes that Peter shared with us the other day. And then maybe, for me at least, most inspiring and impressively, Carver's terrific comments to close out the evening. Really, really thought-provoking. But now for something somewhat different, but yeah, really well done. Now for something not completely different, but orthogonal here, which is what is going on in the capital markets? What is happening out there in the world that is a source for both capital, of course, but is also a source of information, as we've talked about over the last few days. We have an absolutely, there we are, terrific panel. I can't say these are terrific pictures, but that was my executive assistant putting them together. And so you're going to hear from Kristen Zimmerman from Morgan Stanley. She has done a lot of work in the area of these things called SPACs, Special Purpose Acquisition Corporations. There's a lot of simplification of this, but there's actually a lot of complexity to it. And she also, of course, has quite a bit of knowledge around IPOs and direct listings. Brian Mistele is the CEO of a company here that has done some really, really amazing things with data and transportation called Inrix. He's thought a lot about, raised a ton of private capital, and has thought a lot about these different public capital mechanisms. And then Mike Nordtvedt from Wilson. Wilson Sonsini, of course, one of the absolute premier law firms in the country, advising private companies and public companies, and he'll have a terrific perspective on this topic as well. But let's just set a little bit of context. Before I actually talk through this slide, which I think is important, and by the way, I stole some slides from Morgan Stanley. I'd seen some of these slides in a different presentation. I thought they were quite good. But let me give you a data point in the private capital markets. Last year was a record year for venture capital dollars. I don't know if anybody has a sense of the context, but it was over $150 billion of capital was invested in private companies. It was an all-time record. This year, in the first half of the year, that record was broken. And we are on track to have a total of over $300 billion of capital invested in the private markets. Not surprisingly, valuations in the private markets have risen substantially at all stages. And I could go on forever about that, but time does not allow. So what is this slide showing us? What this slide is showing is we're just talking about software companies. And we're talking about principally these days companies called software as a service companies. And as you can see, valuations have skyrocketed. If you look at the blue line, what you're seeing is that, and this is a revenue multiple, not an earnings multiple, a revenue multiple. Software company revenue multiples, pretty strong period of hanging out around a 3 times your revenue valuation. And then a pop-up when software as a service became more the common methodology. The rationale for that is that these revenue streams are much more predictable in a software as a service model. And so you see the jump up to 7x. And then in the last couple of years, this rise to something double that, 14x. And if you, with the green line, the one that your eyes are drawn to, if you look at the very high growers, it's as high as 60, 65. This is companies like CrowdStrike and Snowflake. If you're familiar with those types of companies, we were happily investors in Snowflake. They're the ones that are getting these just seemingly, kind of infinite revenue multiples. And this is a very busy slide, but here's the takeaway. It's growth at almost any price. And the left-hand side shows growth rates in, kind of in the 30, 40, 50%, and a very tight correlation with valuations, those revenue multiple valuations on the left. I'll leave it there because this other one is just basically when you factor in EBITDA, or cash flow generation, not as strong a correlation. The market does not care as much about profitability right now. It really cares about growth. Here's the risk factor that's out there that we all intuitively know. This is basically an analysis that says, what would happen if interest rates started to go up? It would be bad. And that's the takeaway from this slide. Now, here's a couple of other interesting facts before our audience, you hear from our panelists. So this slide, these two graphs seem similar, quite similar, right? What's different is that they're very, very different metrics. On the right is the market cap. The market cap of the 10 largest technology companies in the world a little more than a decade ago, 2008. You add it all up, that market cap, by the way, is a little less than $1 trillion. On the left is the cash that the current top 10 companies have on their balance sheets, which is a little more than $1 trillion. So you've gone from an aggregate market cap of $1 trillion for the 10 biggest tech companies to cash on their balance sheets of over $1 trillion. And that's why on this slide, you see the morphing now, because the now current top 10 tech companies on your right have an aggregate market cap of $12 trillion. We're up 12x in valuation for the largest 10 technology companies in the world. And so they are doing something at least perceived to be right from a value creation perspective over the last decade plus. And then you can see that morphing of that old market cap over here on the left. So it's maybe no surprise that not only are we already at a record year in the quote traditional IPOs. There's been over there's about $170 billion raised in traditional IPOs this year. But there's also been further innovation because there are imperfections, there are problems, there are challenges. There's imperfect information exchange because of imperfect mechanisms with traditional IPOs, and we'll get into that on the panel. And so you've got this innovation called direct listings, which we'll get into it, but in shorthand is when a company just says, here, I'm going to directly list all of my shares. That's one of the issues with it. And anybody can now freely trade them. Now, we're not able to, although people are working on it, raising capital through a direct listing, but it's a mechanism that's been used by companies like Spotify, most recently by Warby Parker, to make their shares available in the public market and then be regulated by the public markets. And then there's this other topic of SPACs. And rather than get into that myself, I'm going to invite these wonderful, wonderful panelists. We're going to have some chairs come up on stage, and we're going to let them begin to share with you. Okay, thank you. Jack's briefing me on our mechanisms here for making this all work. And we're going to start with each of them sharing some of their perspectives on this framing that you see, on this slide of these three different forms of being able to access capital that's available through the public markets and/or have your stock be a tradable secondary market, out in the secondary market performing in the capital markets, entity. And now that we have our chairs, we can invite our panelists to sit, and then I'm going to ask Kristin to start us off with both an introduction of herself and some of her perspectives on these different options.
Can everyone hear me? Okay, perfect. Hi, everyone. My name is Kristen Zimmerman. I'm a managing director at Morgan Stanley based in New York, and I sit in the M&A group. And in that capacity, I actually lead the firm's SPAC M&A efforts. So for those of you that know the SPAC product, it has historically been driven by a capital markets franchise at most investment banks. We were the first bank on the street to create a franchise around the M&A side of the SPAC product. And what we'll talk about a little bit more today is what is a SPAC and how does it work? Because there's components of it where you merge into a shell company that has cash that's been created specifically for the purpose of going out and finding a target and merging with that target. And so what that effectively creates is a backdoor IPO for that target company to raise capital and go public. And so there's elements of a merger to that equation, right? You're negotiating with a SPAC, you're drafting a merger agreement, you're agreeing terms and a term sheet, all of those things that you typically do when you think about selling a company. But then at the same time, There's the capital market side where you're going out and raising capital, additional capital via some PIPE investment, and then ultimately placing those shares to the right homes in the public market with public market investors. So my role there has been to not only help target companies negotiate the process of going public via SPAC, but also to help connect high-quality targets with high-quality SPACs, because what's really important in that is that you are a company that has a deserved right to be public, and then ultimately the SPAC can help you get there. And there's a lot of, I think, to my mind, quality questions in this market environment where there's well over 500 SPACs out there hunting for deals. So we'll talk a little bit more about that, and certainly I can help compare and contrast some of the different listing options as well.
Thank you, Kristin.
Sure. So I'm Byran Mistele. I'm the CEO, co-founder of Inrix, which is a transportation data and SaaS software company. We've raised about $150 million between primary and secondary capital over our 15, 16-year existence. And we have a kind of an interesting perspective as a company that's kind of looked for financing throughout the different process. I mean, if you go way back to sort of the 1980s, you saw this explosion of venture capital, and it's because companies like Apple, they went public after 4 years of existence. So they were able to raise money in the venture capital world and then go public and then continue, obviously, on their growth. That led to this explosion in venture capital. What happened then, though, was 2002, Sarbanes-Oxley made it a lot harder for companies to go public. And at the same time, you've got these big private equity funds and pools of capital that decided, hey, we want to get in earlier because we want kind of the returns and kind of the increase in the stock price. So private equity started moving into growth funds and mezzanine funds. So now companies faced with it's harder to go public and faced with a lot of money in the private sector, waited a lot longer to go public. So you've seen companies go public, whether it was $10 billion, $20, $60 billion in total market cap, way, way later than what they did originally. But now what's happening is the public market folks are feeling left out because obviously the private equity and the private investors now have access to all these returns. And if companies are going public at 60 billion, how much upside do you really have? So the SPACs are really this way of the public folks to basically get in on the party earlier in terms of the private folks. And kind of, this is a good thing, I think, especially for companies like ours, because now you have a range of options. You've got more ability, whether it's through VCs, private equity, and now public markets being opened up more and more through SPAC transactions. You've got a lot more range of options in terms of how you fund your company and how you grow.
Mike?
Hi, I'm Mike Nordtvedt. As Matt mentioned, I'm a partner at Wilson Sonsini. We view ourselves as the leading firm helping growth companies in technology and life sciences in the U.S. And I run our capital markets practice for the firm. And for the first, 18, 19 years of my career, when you're advising companies about how to go public, there was really sort of only one viable option for most companies out there, which was the traditional IPO. More recently, there's been some innovations in the going public transactions. Matt touched on the direct listing path that's relatively new. There's been around 10 or so companies who've taken advantage of that. And that was an innovation led by Morgan Stanley and others on the street, again, to fix what was perceived to be a inefficiency in the pricing mechanism for traditional IPO. Some folks, as they go through the traditional approach, get the feeling that maybe the banks, and sorry, Kristin, for saying this, but since you're an M&A lawyer, I feel like I can, since you're not your capital markets folks, that they sort of have two clients, the company, but also the institutional investors. And when bringing companies to market, things were priced in a way to sort of build in some gains for the institutional investors. And a direct listing is designed to sort of all the stockholders of the company as a potential supply, and a price discovery method to try to find a clearing price at which they'll go public to reduce that inefficiency. And again, I think for certain companies that's it's been successful, but it's only been a few data points. The other, it's not really sort of an innovation because SPACs have been around for quite a while, but there's been a greater acceptance of that as a vehicle for going public. I think historically there may have been a perception that gold medal companies would go public through an IPO, and maybe a bronze medal company would choose a SPAC. I don't think that's true anymore. And as Brian says, it's a way for mainstream investors to potentially get in on really exciting growth opportunities, and we'll talk a little bit more about sort of the structure and how the SPACs work, and the companies that might be a useful way for them to go public.
So to put an exclamation point on one thing that Mike is highlighting here is, if IPOs work so well, why would you ever need these other mechanisms? And so what are the failings of IPOs? And just to give one, and there's many people you can read, Bill Gurley's got some very good writings on this topic. There are others. But one of the ironies is that the mainstream media, when a company goes public and their stock goes up 100%, they're like, oh, what a great IPO. Well, that's an absolute failure as an IPO, because what that says is that the company priced their shares too low, and that their advisors, the capital markets people at Investment Bank, certainly never Colin Stewart and the people at Morgan Stanley, have screwed up. They didn't read the market right. They failed. And so that's why you had some of these innovations like direct listings, and although as we're about to hear, kind of SPAC has its pros and cons to it, out there, because an IPO with a big pop is a failed IPO, arguably. I would argue that. So with that, Kristin is going to give us a little outline here of the pros and cons of these three mechanisms.
Yeah, happy to. And look, there's a lot to cover, so I'll try to keep it as crisp as possible, especially since people on the panel keep pointing at me as all evils. But so let me start with IPOs, because this has really been the gold standard for going public, particularly for technology companies, for a really long time. It's a tried and tested methodology. And what effectively happens in an IPO, as many of you already know, is that you create new shares, right, that are then underwritten by an intermediary like an investment bank to help support those shares. And then you ultimately sell those shares to the public market as a way to raise capital that can then be infused into the business. And so that is something that creates a lot of support for the stock, that type of structure. And the investment bank is obviously helping to think through how to take that business to market. It is galvanizing investors around a roadshow process. It is coming up with a price or a price range for where the shares will ultimately trade. We talked about the dangers of that price range being too low. But the other effective bookend of that is if you don't get up to that level, that's not good either. So it's really hard to price these things, to perfection. But those underwriters provide a lot of support to the process and help the company work through the whole gamut of becoming a public company. You also, in that process, get natural research coverage, right, which is really important as a new public company, that you have folks out there that are supporting your story, you hope, and helping to tell that story to investors. To my mind, it is probably the best path to get shares to the rightful owners who understand your industry, understand your business, understand the value proposition, and that happens more organically than perhaps in some of the other ways. The downsides of a prospective IPO, we talked about the pricing risk, certainly. You have a real market risk up until the bitter end of pricing. So, it could be up to a 6-month process, give or take, from preparation through to pricing. And you're subject to whatever whims the market has that may or may not be indicative to you specifically, right? But then you could also misprice. You also have, as potential investors in that IPO, you have a prospective lockup period of typically 180 days before you can trade. So it's not freely tradable at day one. So that's something certainly to consider. And I would also make the point that when you are marketing a company that's going public via an IPO, that marketing process is predominantly focused on historical performance. You can't use projections to market the business in an IPO the way you can, for example, in a SPAC process. And so sometimes that can hinder you. You can, of course, tell some of that story to research analysts, and then they can convey that to the broader investor base. But that's happening through secondhand, and it's not directly through you. So sometimes things get lost in translation, or perhaps research analysts are more skeptical than you would be. So those are just some of the things that affect how folks consider IPOs. But nonetheless, from a technology perspective, there's a lot of cachet to being able to be an IPO candidate. Now, SPACs are another way to raise capital via an IPO. I would call them effectively a form of a backdoor IPO. And as I mentioned earlier, SPACs are effectively companies that are set up. They go out and raise a significant amount of capital that is earmarked to find a company. They can't identify that company before they go out and raise the capital, only after that capital is raised. And then they go on the hunt, and they ultimately marry up with a target company. And in that merger process, the SPAC has cash. They have nothing else, but they have cash. It's effectively a blank shell company. And they merge with that target company, and that target company then becomes public because the SPAC is already public. So the benefits of doing that are, as part of that process, oftentimes you see these SPAC sponsors, as they're called, the people that are out there leading the charge from the SPAC side. They bring on board PIPE investors earlier on in the process. So it's a bit of a mini private IPO. And they use that PIPE process to raise additional capital in addition to the SPAC trust fund that they already have in place. And so that in some cases can increase the amount of capital a company can get in this whole process. And it also, as you go out and market to PIPE investors, that it provides validation of the story, of the positioning of the business, and of the valuation. So to a degree, you may be able to influence and set valuation long before you ever get to closing. So it brings forward some of the elements of the IPO that I talked about having to wait to the bitter end. Now, today's market conditions are much more challenging, and that's been harder to do versus when we were going through SPAC mania in let's say, February and March of this year. But nonetheless, it's still an important facet of this structure. I think the other important thing here, and I mentioned it earlier, but it's also been critical, you can use projections to market your business in a SPAC context. And so if you have a more complex story to tell, a more nuanced story to tell, the SPAC process might be a better way to go public, because in an IPO, those things don't come to life the way you could do in a SPAC, where you have a PIPE and you're telling the story early and you're able to talk about projections on a 3-year forward onward basis. And that's why you saw a lot of high flyers going public early on in their days of SPACs, flying cars, for example. We took Joby Aviation public, and space companies and things of that nature. They're certainly not profitable today, and many of them didn't even have revenue at the time. They were 5 years out from having revenue, but they could use the vision of their projections to sell that to investors, and investors who really are excited about growth were buying into that story up until reasonably recently. And lastly, on the pros there, a SPAC sponsor partner can sometimes be perceived to add value either as an operator who knows the industry very well, can bring cachet, can bring their Rolodex of relationships and whatnot. And in some cases, you see them, and more often than not, in this day environment, it's demanded that they put money into the deal themselves, their own personal wealth or friends and family, to make sure that the PIPE can be successful, and then ultimately that the deal will close. So that takes me to some of the downsides of SPACs. There have historically been a couple of Achilles heels in particular, and one is that the SPAC trust capital that I talked about is subject to 100% redemptions. So at the end of the day, what happens is you agree a deal between a SPAC and a target company. The SPAC and the target company go out and navigate a PIPE process, and let's say they raise anywhere 100 million plus of PIPE capital. Together, they link arms. That capital is committed. They sign a merger agreement. They announce a deal, and then they go out and file a proxy with the SEC. At the end of that proxy process, then you go to the redemption vote and the shareholder vote. And the SPAC investors have a referendum on whether or not they think this is a good deal or a bad deal. And so if they don't like the deal, they can take 100% of their capital back at that point in time. So that's been a really important consideration around deal certainty for these things. You have to have high conviction that you can get a PIPE in place, right? That's been a linchpin of why these things have been working in this day and age. And so obviously, if you have massive redemptions, and we're seeing somewhere around average of 60% redemptions in the last 3 months, a lot of that capital goes out the window.
You know, I think maybe because Mike has got a lot of great experience in here, we'll hold a little bit on direct listings, and we'll come back to that. And Mike, maybe you can just walk us through from a kind of a legal and regulatory perspective, because what we're basically saying here is that, you know, somebody went out and raised a pool of capital that intentionally at the beginning they don't know who they're going to get married to. You know, so they've got this pool of capital, they've got their dowry, if you want to think of it that way, and then they're going on a bunch of dates. And then they finally find somebody and they get engaged. And like the typical engagement, this process goes on for months, and you're planning the wedding. But at the very end, before you consummate the wedding, you can take your money and go. I mean, it's kind of an interesting process, you know, I guess being left at the altar, as it were. The only people that are committed are the institutional investors that signed up for that pipe thing that was kind of coming along in the middle of the process. So, Mike, talk us through this a little bit more.
Yeah, so it's a really interesting process, and it's sort of multi-phased. The first one is the SPAC does a regular way IPO, and again, there's not much to that. They just the sponsor team, they sort of investment in them. They think they're going to be able to identify a good opportunity, and that money is just sitting there in the trust account, as Kristin said. And what they get in return is common stock in the SPAC and some warrants. And those two things are detachable, and we'll get to that in a second. But once the IPO closes, then as Matt says, you go on a bunch of dates and you try to find a good investment opportunity, and you set price at an LOI very early on in the process, before you really had an opportunity to test the thesis with broader market participants. You sign your LOI, you agree as to between the SPAC and the company as to price, and then while you're negotiating your definitive merger agreement, you're going out and marketing the PIPE, or private investment in public equity, where institutional investors are committing to invest in the SPAC at the same price that the IPO investors did, and that actually can be a real point of failure. I mean, SPACs, when they're run well, they give companies greater price certainty earlier on in the process. But once you turn around and talk to the institutional investor, that's the point of it. They get a vote too. And there's lots of deals where the valuation that you agree to with your SPAC sponsor up front doesn't actually end up being what the price is when you sign your definitive agreement, because there's a signal from the PIPE investors as to whether they agree with that valuation or not. At the beginning of the year, during SPAC mania, PIPEs, they would maybe take a half-hour meeting and they'd ask where to send a check. It was almost that simple. Working through the year, that part of the market, there was a little more discernment, and a lot of deals that the prices got recut. But fast forward, you've got your PIPE investment as a little bit of a backstop against the redemptions. You sign your merger agreement, and then you go through at that point sort of pretty similar to what a traditional IPO process is, where you're engaging with the SEC around the disclosure about the company. That's not sort of a market-based point of failure, but as we've seen over the past year, when folks have been reading the Wall Street Journal, the SEC has not been super constructive with the SPAC product. I think they were definitely trying to do more than tap the brakes, or slam the brakes a little bit on the market. And some of it's been job owning by folks on the staff. Part of it's been reviewers taking their time. Some of it's been taking a look at accounting for some of the parts of the SPAC process that's really sort of slowed down people going through the system, and that has had a inhibiting effect on deals, because there's less certainty as to timing of when you'll be able to actually go public, and that introduces market risk, which we've seen so far. And then again, at the end, you've got a vote of the SPAC investors, and that's where the structure of the securities is really interesting, and really well designed, the investors can get, if they'll vote, they can vote for the deal or vote again for the deal, but at the same time ask to get their money back. And when they do that, they also get to keep their warrants. So the incentives are all geared towards approving their transaction. The money may or may not be there for the operating company, but they're incentivized to approve it. But they get to keep a little warrants in case maybe this ends up working out pretty well. So there's sort of different points of failure.
So the deck is a little bit stacked against the poor company. So let's bring the company CEO in here to get his perspective on all of these, not only the private markets, which obviously Brian and his team have done an incredible job raising capital in over the years, but how you'd even think about these different options, for potentially being a public company.
Well, just to be clear, the deck is always stacked against the founder. No, so if you look at, there's a couple of fundamental problems in the whole financing process in general, right? Financing problem number one is, in the early days of a company, before you have revenue, before you have earnings, your valuation is basically how big the dream is, right? How much you can sell, to Joe Schmo to basically give you money in the venture capital world. So these companies get valued at, potentially huge valuations, even though no revenue, no customers. It's all about the dream. Right? I made the mistake of going to the Harvard Business School. And I say it's a mistake is because they taught you the goal of an organization is to make money. That's not the case at all, okay? Because the minute you start making money in the venture capital world, now folks value you on earnings and multiple of revenue, right? That's it. So you go from this world where you're valued at the dream, the next year you earn a profit, and now all of a sudden you're valued at, 5x, 6x revenue or 10, 15x or EBITDA, and your valuation drops, right? This is what I call the tweener problem, where it's very hard to raise money the minute you turn profitable because you're not big enough to be valued off of real earnings and revenue multiples, whereas yesterday you were valued on the dream. So it's very hard to raise money unless you're doing something inorganic like an acquisition or something like that. So we've done a couple acquisitions, easy to raise money, but for us, we went from being data platform for mobility to now we're investing very heavily in SaaS software for mobility. So think of it as Bloomberg for mobility. That requires capital, but the challenge is, like you said, this tweener problem. So the SPAC doesn't solve every problem the company has, but it does solve some problems, right? I want to use Matt's analogy, right? You go through the traditional IPO process, you don't know who you're marrying until the bride lifts up the veil at the altar because your book isn't built until the very end, right? Whereas at least with the SPAC process, there's a courtship process, right? You get to talk to all these SPACs, you get to understand who you're going to be working with. So at the end of the day, there's at least a courting process before you get married and you get the dowry, right? The second thing, obviously the benefit of the early part of this year is, there's 400 or 500 SPACs running around looking for companies, right? So, you're going to the prom and there's 400 or 500 guys looking for dates and there's not that many good looking dates around. So your odds as a company and your value goes up simply because of supply and demand, right? And then the biggest value is, look, at the end of the day, for a company, for a founder, what do you care about? You care about valuation, you care about raising the money you need to operate, and you care about liquidity for your shareholders, right? So liquidity, public route or SPAC is essentially the same. You get your liquidity. The SPAC allows you to set the valuation or at least get a good idea of the valuation early in the game as opposed to traditional IPO where it's late in the game. And that allows you to control the dilution, right? You can at least understand the dilution, plan for the dilution, and if you don't like it, you can pull out much earlier than later. So the SPAC doesn't solve all the problems. Companies are, it's still high cost, right? Just like an IPO is very high cost for a company and it's a complicated transaction, but it does solve some of the problems that do exist.
Well, and this is actually a perfect moment to bring in the direct listing because embedded in here are two pieces that are speaking to the imperfections of the traditional IPO and even candidly to the SPAC, which is one, you're only raising a small amount of capital relative to the overall market valuation. And so your float is relatively small, either through an IPO or through a SPAC. And then as Kristin referred to before, there's this concept of the lockup. So you're artificially constraining additional shares from being sold in the secondary market. And so you have the potential, up or down, more often, up or down, of distorting the actual market value of that company because of the scarcity of supply of shares that are freely tradable at that point in time in the market. And these are, I think, the valid criticisms that led to the innovation of the direct listing.
Yeah, I think that's right. I mean, look, I think with the direct listing, what you're effectively doing is taking shares that are held by the existing stakeholders and selling them to new investors, right? And so there's no primary. The benefits of doing that are the fact that you're not going through this artificial price setting mechanism that you would be in an IPO where an underwriter is setting a range. You're allowing the market to have a referendum on where this thing should trade. And if you have a lot of investors out there that you think will have strong conviction, then ultimately that could be a really good outcome for everybody, right? On the flip side of that, though, you don't have a safety net, right? You don't have an underwriter doing the work for you the way you would in a regular IPO. So that's important. The company that puts the burden on the company to really go out and market this in the right way. And the other thing I would say is there's not a lot of margin for error here. You really have to execute this to perfection to get the right outcome. There's probably been about 10 of these done since Spotify a couple of years ago. And so there have been some real success stories, but there have been others that have been subject to a lot more volatility and liquidity concerns coming out of the gate once they price. So this is, and also look, this is something that you might consider if you don't need a capital injection in the business. You want to get out and be a public company. You want all the benefits of doing that, but you don't necessarily need a big capital infusion into your business plan or to keep you competitive with others that are out there in the market.
Yeah, and I'm going to invite Mike in because so these are, fluid kinds of, situations. There's some regulatory changes that are afoot that I'll invite Mike in on. But then there's also other ways that just the folks out in the capital markets world solve for these. So take a company called Roblox. Roblox, many of your kids and your grandkids use Roblox. It's a sort of a virtual reality gaming world. And Roblox raised a private round at a price close to $40 billion just days before they went public via a direct listing. So they raised the capital through the private round, set a reference price, and then made all their shares freely available to trade. And so in advance of the regulators catching up with it, that's how they solve for their needs. But what's going on in terms of the moving pieces in this world?
Yeah, I mean, so far, there's still work being done on allowing primary listings in the context of a direct listing.
Meaning that somebody can raise capital
At the market clearing price. So far, no one's actually been able to do that yet. And so for companies that do need or want capital, they do private rounds in advance of the direct listing. Most companies, they're not going to do it like Roblox did, like right on the eve of the direct listing. It's something sort of prior to that. Some bankers, capital markets bankers, will say, yes, you'll get better pricing at the time of the direct listing because it's at least in theory, a more efficient process. But and that's good for the stockholders who want to sell. But for the company, like you're still going to probably sell at a discount because you're going to be raising money sort of in the lead up to the direct listing, and that's going to be at some discount. So it's sort of a question of who's going to get the gain. Is it going to be the private investors who are investing sort of in a year or year and a half before the direct listing, or is it going to be the institutional investors who might have otherwise come into the traditional IPO? So there's some dynamics that you can see that are happening there. The other interesting thing that I see is some of the innovations that you're seeing in certain parts of the capital markets are starting to bleed over into the traditional IPO as well. I mean, Kristin mentioned earlier, it used to be if you did a traditional IPO, it was a 180-day lockup for all your existing investors, and that is massive, sort of artificially constraining the supply, which helps to sort of maintain the price and give certainty to the institutional investors that they'll get a gain or at least not a loss. But we're also seeing now day one lockup releases for a portion of the shares, and sort of increasing some of the ability of investors to get early liquidity. So there's a little bit, while there's additional technology that people are taking advantage of, there's also convergence in other areas as well, trying to get the best of all the facets of the different approaches.
Kristin, maybe you can comment a little bit more on some of these other pieces. I mean, we've certainly experienced, I referenced Snowflake earlier. Snowflake had a mechanism that if the stock was trading above X, after the first earnings release, then there was a portion of the lockup that came off. So these different mechanisms to go from the more rigid 180 days, all these other shares are locked up, to certain kinds of aligned mechanisms that allow you to have more secondary market liquidity. I mean, what else are you seeing that are some of these pieces that maybe are more flexibility in the IPO market in response to innovations like direct listings and SPACs?
Well, it's interesting. I mean, I think the IPO market, having seen the SPAC market take off in late 2020, started to feel some real competitive pressure.
Yep.
And so there's a lot new technology, no pun intended, around the capital markets today than there ever was before. I mean, things that I never thought would get done have gotten done. So, and I think it's a very evolving market. I mean, SPACs in particular are a microcosm of this. We did go from SPAC mania to SPACtivism in the course of 6 months or less, I would argue. And that's still evolving as we speak. We're seeing a lot more structure. We're seeing more, aggressive lockup or lack of lockup mechanisms, more flexibility in some investors getting a pass in terms of a lockup on the SPAC side. And as you see that happening in these new areas of SPAC land and then maybe direct listings as well, I think you'll continue to see an evolution in the IPO market, the traditional IPO market. And then you're also seeing, companies getting out, becoming public via the SPAC product. And in this market environment where we're seeing a lot of pressure on valuations, we're seeing a lot of pressure on downward pressure on pipe sizes and things of that like, some companies are like, I just want to get out there. And once I get out there, I'll figure it out and I'll do some follow-ons and raise additional capital to get better liquidity. Because a few of them are coming out of this market and limping out of the gate from the SPAC side, the SPAC closing process.
Yeah, I think that over half of the SPACs that have completed the de-SPAC process in the past year are actually trading under the $10 a share, which is the standard, share price for a de-SPAC valuation. So there's definitely a number of them that are struggling. Brian, you must talk to other CEOs, some that have gone through these processes, some that have chosen different routes. What are the learnings for you that you're hearing from others, perhaps things that you're thinking about yourself over the long term as you hear all these different moving pieces and these different options?
Yeah, so I think the one takeaway is there is no one perfect answer, right? Different companies are in different situations and as a result have different options, right? The direct listing, for instance, works for Spotify because everybody knows who they are, everybody gets it, and they don't have to have the story told, right? Somebody like Inrix, right? We're not a consumer brand. Our story is, SaaS software and mobility, and that's not a retail story. People don't buy that based on one posting on Reddit. Folks like Lucid, they will buy it based on one posting on Reddit, right? So direct listing works for some companies, not for others, right? Traditional IPO route works for other companies, right? History of earnings, long kind of, backward trend that they can kind of point to, right? Companies, for instance, like ours, where, we are in this change where our SaaS software is driving all the growth, but it's only a year or so old. You want to be able to tell that forward story, right? And the benefit of the SPAC is, again, you have a period of courtship where you're talking to an intelligent investor on the other side of the table, where you can basically have time to explain, here's what we're doing in SaaS software, here's what the forward-looking story looks like, here's the confidence we have, et cetera. So there's an intelligent conversation. It's not a matter of somebody reading a post on Reddit and saying, yeah, okay, I want to go buy into that. So like I said, different companies, different pros and cons. Like I said, none of them are flawless. If I were to redesign the entire market, it would look very different than it does today. But at least now you have more options than you had a year ago, which is a good thing.
So I'm going to ask one or two more questions of this group. And specifically, I want to get Mike to weigh in on sort of regulatory issues and regulatory changes afoot across these different types of options. And then we'll invite some questions from the audience. So Mike, can you comment on this? We hinted at it a little bit with the potential allowance of a capital raise on a direct listing, but there's a number of moving pieces. You talked about the crackdown by the SEC as well on SPACs. What are some of the things that are going on for the benefit of the audience? Yeah,
I think there's a sort of a sign, watch this space on the SPAC market. Acting Director Coates is back in, I guess it was April, put out a statement. It was sort of musing about the SPAC product and how it really should be treated as a traditional IPO. The problem is the structure of the transaction doesn't really sort of fit with the traditional concepts in an IPO. So it's actually really hard to think who's the issuer, who's the underwriter, who's taking liability for what statement, and it doesn't really fit in quite the sort of facile way he sort of suggested that it could. But I think that the staff is going to put out some rulemaking here shortly that's going to provide some additional guidance about how that ends up working. And specifically, I think sort of anticipating sort of potentially heightened liability for some of the forward-looking projections that Brian was talking about. There's a facet of the law that provides some safe harbors for people to make those types of forward-looking statements, which I think that investors should be able to get as long as they're reasonable and you have appropriate cautionary language. There's the staff is sort of signaling that they're not going to sort of allow some of those protections that people thought were available, and so I think that has the potential to cool the market a little bit further, or you potentially have people take more time and be really certain as to what they're saying and how they're saying, and having other folks involved in the process take really hard looks at it, which I think would be a positive thing for the market.
To put a finer point on it, so Madrona's had 5 companies go public in the last 18 months, 3 by traditional IPO with different modifications. I referenced Snowflake UiPath as well was another one. And then we've had 2 go public via SPAC. And what happened as they were going through the later stages, now you've married or gotten engaged to the SPAC partner, you've gone and raised the pipe, and now in the spring of this year, these companies are trying to get through all the SEC hurdles. And all of a sudden, the SEC is like, we're going to change our view on how we account for things like warrants, and that became a whole, kind of slowing down a roadblock in the process. And then the one that was a little bit more amusing to me was all of a sudden the SEC thought that they were capital markets experts, and they're like, well, tell us about these projections, and SPAC, tell us about how you valued this company, and why did you value, and who were the comps that you were looking at, and all this stuff. And it really got into this, didn't realize that was the area of expertise for the SEC. And so these are the kinds of things that are going on kind of under the covers, as it were, in the SPAC market right now that have created roadblocks in the process. It's 6 to 9 months now from that original letter of intent, until your company is de-SPACed, should you be able to raise the pipe and get through all of this process and be fortunate enough to have few enough redemptions to actually have a SPAC that's worth kind of completing. Kristen, I am curious about this broader capital markets. I put up these slides at the beginning. Obviously, in general, valuations are at all-time highs. You just see it in even the general markets. And as I referenced, there is a record number of capital raised. We're not quite at a record number yet of actual IPOs this year. But the mindset even 3 or 4 years ago was stay private as long as you possibly can. So a little bit from your end, what has changed in that mindset? Why has that changed? And now we're having these record years of public capital raising.
Well, look, I think it comes down to supply and demand at its core. And I would say we're in an environment with respect to technology where technology is permeating everything. It's not just about regular way software, et cetera, anymore. Technology is across all industries, from industrials, old widget companies, through to biotech, through to CRG companies, consumer retail companies, and things around ESG for that matter, things that are technology that's being deployed to save the planet. Mm-hmm. So, I think that there's a tremendous amount of supply out there of companies that have real growth, mm-hmm. real TAM. They have disruptive technologies applied to them, and investors are really attracted to that, right? When you think about going public, that's what they're looking for. They like those disruptive stories. They like things that are bringing new applications to the market. So from an investor perspective, the demand is there, the supply is there. And then on the company side, we're looking at valuations that, for example, in software, we haven't seen in 20 years. I mean, the multiples are incredibly robust. And so I would argue that target companies are seeking to tap that while the market continues to be constructive. And, to the point we make right now, as from where I sit, I don't necessarily see a catalyst, a near-term catalyst to that changing, although you did mention about, potentially if there are more rate changes or tapering by the Fed and things of that nature, because these businesses are so driven by growth, and you think about how they're valued on a discounted forward equity or enterprise value basis. discount rate matters a lot. So that might be one headwind that we could see, but obviously nothing imminent. So anyway, I think it comes down to that, fundamentals.
Any perspectives that either of other panelists want to add on this before we try to see if there's any questions from the audience? Just to build on that point, just one thing. I mean, I think we do have the alternatives for returns on capital. I mean, you probably all are underwhelmed by what you're getting on your bonds right now. And so that is another factor at play here in terms of, maybe it feels highly valued, but if I'm going to, get some kind of a better, return, the equities are, they're high risk, they're high growth, but maybe a better risk reward than some of the other places I can put my capital.
So INX was launched this year as a tradable crypto token, and so I'm interested in your perspective on companies that basically can go public with being offered to non-accredited investors, and then the investors have 24/7 trading that can occur immediately once that token is sold. So I'm interested in your perspective on that.
I think that's an evolving market, right? I think crypto and things of that nature are still very much coming to fruition and understanding of how they're going to be traded in the capital markets. I do think that as it stands right now, I think there's a bit of conservatism about what sort of investors, accredited or non-accredited, are the right ultimate home for those things. And so, I don't know that I have a good view about exactly where that's going, other than to say that there's a lot of smarter minds than me trying to figure that out as we speak. It's very much top of mind.
One thing I would add to this, we have thought some about it, is distinguishing between, a mechanism, generically speaking, crypto as a source of capital, then from the alternative perspective as a source of ownership. I want to be a partial owner in some asset. The asset could be a company, right? So I buy a share through some mechanism. And then the third thing is your capital markets point about how freely tradable is this? And, as you kind of probably heard in my remarks, that, one of my skepticisms of the traditional IPO is that you're not actually so freely tradable, right? Because there's a very limited amount of the supply of the stock, and, it gets traded in a, quote, kind of active capital market, and then you have all the dark pool capital that's going on as well. So I do think it's early, but it's useful to disaggregate those three things as it relates to, what the sort of crypto ecosystem might be able to help enable and facilitate. The thing I like the most about it is it puts pressure on the system. The same way that having an alternative currency that's not controlled by any single government puts pressure on the system for all the way that these different governments might choose to manipulate their own currencies. I think we have time for maybe one more question.
The Trump SPAC, good, bad, ugly?
The question was to everybody here at the Trump SPAC, good, bad, ugly.
So I'll just give you some facts about this one. And this is sort of exactly to some of the things that Mike was talking about what the SEC is cracking down on. This was a SPAC that went out and put out an investor deck, a traditional investor deck of around, let's say, 20 to 30 pages. There was not a single number in it that wasn't a page number. I'm not joking. And it was a lot of pictures of, the Taliban and things of that nature. So it was not a lot of substance in that. And I think the question is how good should you as an investor feel about that premise, right? Without really doing your homework. And it was also one that got announced very quickly thereafter, after the SPAC IPO'd. I think it was done within, weeks. I don't know the specific weeks, but it wasn't many months. Whereas you could get a sense that, did they actually do their homework? I don't know. I'm not close to it, but those are just some of the facts that jumped out at me when I thought about it. And so the question is, are retail investors at the end of the day left holding the bag on a company that's really viable? And maybe it is. I don't know. But that is the question.
Hey, Mike, maybe you can just comment too on this whole concept around when the original SPAC is raised and you've got this blank check public company, there are regulatory rules around, knowing who you're going to get engaged to.
Yeah, I mean, the whole theory behind the SPAC is that, like, there isn't a specific company or a specific investment that you have in mind. Because if you had a specific company or specific investment in mind, then, like, the disclosure in the IPO should be specific to that investment, so people can make the decision about whether they like that deal. I know there's a little bit of tension there, but that's the idea, and it's a real no-no for sponsors to sort of pre-wire the operating company that they're going to work with, and the timing on the Trump SPAC would suggest that there was some discussion that happened. So that could be another. We'll see how that one goes through with its through the SEC review process. It might take a little bit longer than the normal one.
Just for the record, Matt, as a company, I'm a big fan of companies being way overvalued going through this back process.
I totally understand that, assuming you can get through the de-SPAC process. Well, with that final note, I just really want to thank this terrific panel, and hopefully you learned something new about these different access forms to the capital markets.